Yes, was an announcement on that, and maybe an improvement in the set on the
pass yet? I haven't looked at it in any detail as yet around it, but I can find out for you and let you know.
No, don't worry. Just if you had it, if you're aware of it, it's not important.
Because the UK is it the autumn statement? It's next couple of weeks, is it?
Yeah, 27th of October.
27th of October. Yeah. So interesting to see whether things like the capital gains tax and stuff like that has always been muted, but whether any of those things change. But it'll be the 27th of October. Whether we hear more.
Yeah, no, it's just with the budget in the south there, and I know the likes of the IVCA and the Scale Up Institute, all these organisations, HBAN, are calling for improvements to that offering, and I think there was a small improvement to it, but yeah.
Is the guys in the south doing something similar with a tax and funding theme, or I don't know? Do
you know something, Charlie? I'm not even sure. I need to catch up with Harry.
Yeah.
I honestly don't know.
Okay. And Mark Green, you're about 40 minutes or so, roughly.
Yeah, between half an hour and 40 minutes. Yeah, so 35, 40.
Okay. Perfect. And when we're not speaking, Natasha, we go off camera, is that right?
Yeah, I mean, because there's sort of less of you, Charlie, and it's only really, obviously Mark and Lorraine who are actually presenting. I don't think it matters as much just this time round, but look, it's it's obviously if you feel more comfortable just to come off, that's no problem. Yeah.
Okay.
Guys, I'll just go ahead and maybe start this now and just let the people start filtering in if that's all right. I know it's 1 minute early, but just let people on in, okay? So I'm just going to do that now.
Good morning. Good morning, everyone. I think everyone that is joining us, or the vast majority of those that are joining us this morning, are with us at this stage. So thank you for doing just that. Thank you for joining us this morning. These events, InterTrade Ireland have been putting on, organising in conjunction with Grant Thornton for quite some time now. I suppose they came about as a means to help established businesses source new or alternative sources of funds to help finance business growth. So typically we would have businesses who have been through that process, who have been on a fundraising journey, have been there and done that and wore the t-shirt, coming on and as a case study explaining to us their learnings. And we would typically also have, representatives maybe of one of the banks and maybe somebody from, the business angel community or the equity, the VC community, and alternative sources of finance, I guess. Today is slightly different. We're going to talk more about, the tax side of things, and we're going to look at the tax implications around funding. The importance of getting the right funding mix, and ensuring or working as best as possible to get the optimum funding structure. So delighted to have Charlie. We're going to hear from Charlie, from Mark, and from Lorraine. So thank you to each of you, and also to Natasha and Aidan for your help. So I'm not going to speak for very long. You're clearly not here to hear from me, but Natasha or Aidan, if you just click on to the next slide, I just want to talk very, very quickly about InterTrade Ireland and some of the things that we do and the programs that we run. So Brexit remains very, very relevant to everyone, and our Brexit team are very, very busy organising events, a huge amount of content on our website, and of course the all-important Brexit vouchers. The raise funding piece is the team that I manage, and we run the seed corn competition, the venture capital conference, the equity clinics, and the likes of today's event, the funding advisory service for established SMEs. On the sales side of things, we have Elevate and Acumen, which may be very familiar to some of you. On the winning tender side of things, my colleague Grant heads up that team, and they do a great deal of work there, go to tender programs and meet the buyer events. So with all these, I would encourage you to take a look at the InterTrade Ireland website. Sorry, my connection just dropped there. Apologies. So I suppose just before I hand you over to Charlie, I just want to encourage you to get as much as possible out of this morning. There'll be a Q&A session at the end, so please use that as best as possible. And I know Charlie will touch on it later, and my colleague Gary will send information regarding it tomorrow. This afternoon or tomorrow, but the one-to-one, there's an opportunity for a small number of businesses that attend these events to have a one-to-one meeting with, corporate finance tax expert from within Grant Thornton. So I would encourage you to avail of that opportunity. So thank you for coming on, and I'll hand you over to Charlie.
Thanks very much, Shane, and good morning, everyone. Thanks very much to InterTrade. We're delighted to be working with InterTrade, as Shane said, for a number of years now in relation to the funding advisory programme, and that's across the island of Ireland. So, and again, funding remains very much that key issue for SMEs. So I suppose I'm going to give a wee bit of overview and context to it. So I suppose from a funding environment, a very, very high overview, we think the next 12 months is actually going to be quite interesting in relation to the funding market for SMEs. We have, I suppose, a number of factors. We are coming out, hopefully, out of the COVID pandemic and rebuilding back up again. We have had seeing the end of the government support schemes and new loan schemes coming into play. And certainly at the minute, while there's a number of obviously challenges in relation to staff, logistics, etc., etc. There's a sense, I suppose, of still positivity in relation to SMEs out there. So we'll be watching quite closely in relation to the whole investment sentiment, because that very much then drives a lot of that funding environment. We believe that there's going to be an increased role for alternative funders in the next 12 months, and it would be quite interesting just to see how that all plays out. In relation to private equity, they still have that wall of money looking for homes, etc. So we've seen quite a bit of activity in relation to direct investment, but also some of their corporates who they've invested in, then looking at M&A activity as well. So that's been at a height that we haven't seen for, I suppose, a number of years. So that's all positive. So hopefully we're looking at whilst we know there's challenges there, it's still very much on that optimistic side. So anybody who has been involved in any of the webinars before would have heard me indicating the importance for people to try and understand what the funding requirement is. And some would say, well, that must be completely immediately obvious, but certainly from our own context and some of the submissions that we have seen, and from anecdotal evidence back from some of the funders, it's not that immediately evident, but absolutely, obviously, quite critical. And anybody again would have heard in relation to the most cost-effective funding that a SME can look at is from their own resources. So there's cash that is in the bank account and visible, but we also said is identify and try and look at some of those what we call the cash in the cupboards, the cash that isn't yet identified. And certainly a key source of that is, we believe, in relation to looking at very effective and efficient tax advice around the funding, and getting that right can have a big impact in relation to the overall quantum of the funding requirement for the business, but also in relation to understanding the timings of that. So we work very, very closely with our colleagues Mark and Lorraine in relation to all of the work that we're doing with our clients. And clearly those cash projections are pretty key. And from anybody will have in the business will know that the tax amounts can be quite chunky, and they can have quite a big impact, certainly in those short-term funding. So it's important to get that right. So this morning, Mark and Lorraine will chat through some of the major issues that they believe that your advisor needs to be considering when looking at the whole funding environment. And I suppose getting that right can have positivity, but on the other side of it, you want to avoid the bear traps. And clearly, one of the things from revenue who are looking at some of the sort of the events that they see within companies, so things like changes in structure, if you're looking at additional deductions, etc., those will come into focus from the revenue point of view. So again, the importance of actually to try and understand to get that right. So Mark, and Lorraine will look through some of the key issues. They will weave in some of the case studies, so some of the examples that they have seen. As Shane has said, there's a Q&A session after the presentation this morning. So I would invite people to then post questions through that chat function, and we will try and answer as many, if not all, of the questions that you posed this morning. One, I suppose, point is that while our colleagues will be able to give some generic answers in relation to that, obviously it won't be specific advice, and clearly that would be you would need to then talk specifically then to your tax advisor there. So without further ado, I'll hand over to my colleague Mark. So if you want to take it away, Mark, thank you.
Cheers, thanks, Charlie. Good morning, everyone. My name's Mark Bradley. I'm a corporation tax director in Grant Thornton in Belfast office. I suppose a lot of my day-to-day work is in respect of advising on transactions, advising both the companies and the shareholders on their structures, but also looking at how they're financed and ensuring not just in the current position around tax deductibility, how does that play out over their period and their lifespan in terms of repayment of debt. Also looking at whether or not when businesses are looking at new financing, looking at their current debt structure, and does that need restructured prior to the introduction of new and fresh debt, whether that's by debt or equity. So to cover off what myself and Lorraine will discuss throughout the next half an hour or so, are the tax principles of financing and the deductibility of interest, characterization of what I suppose the revenue deem the debt or equity, but also around some anti-avoidance provisions that are becoming to the fore with the revenue. In the past, certain aspects wouldn't have been reviewed as often as now, but now with, I suppose, a lot more private equity transactions, etc., occurring, there is a greater scrutiny around, I suppose, tax deductibility of interest. So I think if we look now at probably what the types of financing are, it's nearly to take a step back and from the sort of, I suppose, 101, what is debt? I suppose, what is debt? I suppose the general characteristic of debt is that it will fall to be repaid at a point in time. So if the creditor has no legal right to any of the consideration, there's no debt. I suppose the point is, why is that important to define? Well, it's important to define because it will actually determine from a tax perspective whether the repayment of debt or the repayment of interest on debt is actually deductible or not. So the main types of financing from a debt perspective, as everyone will know, will be most typically from banks. Again, usually secured debt, lower interest rates, interest is payable on a monthly, quarterly basis, and ordinarily the company will take a deduction for that interest. There won't be there is no deduction for any repayment of capital. Mezzanine, again, very much like bank debt. What we have is a position where there's probably slightly higher interest rates. It may be secured, may not be secured, but again, ordinarily deduction is available for the interest, but no deduction will be available on the repayment of capital. Fixed asset financing, again, is another area where lots of businesses look at whether that is hire purchase or operating lease. So again, slightly different how they are operating. With a hire purchase, broadly that would sit on the asset would sit on your balance sheet, and the company would claim capital allowances. On an operating lease, it is effectively a rental charge, and a deduction should be available for any, I suppose, rental payments on that. Other areas of financing, and as Charlie mentioned there at the start, was around, I suppose, cash that shareholders may have and be able to introduce into the business. What we see now a lot of from individual shareholder loans is more than likely they're interest free. Again, they're unsecured. But what we're also seeing is that because that happens, there is an opportunity again to charge interest on those loans from the shareholders. Probably more so a higher rate than what the bank would charge. What that does, that can also allow for some efficient remuneration planning. Now, saying that, there are some withholding tax requirements, and Lorraine will probably cover those off later on in the presentation. Another area is that group loans are related party loans from other companies that may sit outside the group or the current structure. So if you've got two businesses, two corporates, one is cash generative and the other requires it, there is, and we can always go down an intercompany loan. Usually what we find with businesses that this is very much on an ad hoc basis. I think for good governance, what we would always recommend is that there are sort of formal loan agreements in place. What we also find is that normally in some of these intercompany loans, there's no interest charged. Now, that can be fine if it's UK to UK, and sometimes with the accounting now, there is an imputed interest requirement to go through that. There is also what we just have to be wary of is that if it's going from the UK to another jurisdiction outside of the UK, there might be a disparity in tax. And it's where other areas of the legislation come into play, whereby you may have to impute interest on that. And again, it's working through that just to determine whether what's the most appropriate charge and what does that look like from a tax perspective. Also within the types of financing that falls within this is the cost of financing. Costs of financing are also deductible for tax purposes. So whether that is, for instance, doing your business plan, having your professional advisor, go out and search for finance, but also any banking costs in respect of it. So once we talk about debt, the other area is around equity. So again, this is around getting finance into the business. And again, with equity, there's a completely different tax structure in respect of it. Usually there are two types from a share perspective. One is ordinary shares, and the other is preference shares. So to take ordinary shares, when you put money on if you subscribe for shares, ordinary shares in the business, cash will go into the business. You will be issued with shares in the company, and it's there to really strengthen the balance sheet. It's not a debt-like item within that. Preference shares from accounting perspectives may be treated as debt. There's usually an annual coupon with preference shares, or they're rolled up. So what we normally find with preference shares is that if a company issues them, it's a bit like a loan note. There's usually a percentage rate of 5 or 6% on a preference share. What we find with a lot of businesses is that it's rolled up and payable on exit. So when there is an exit event, so what that means is that the company doesn't necessarily have to have the cash at that time to pay out on an annual basis any dividends. The beauty around that as well for anyone who is in receipt of them is that they will ordinarily only be taxed on the receipt of those rolled up coupons as such, so not actually on an annual basis. I suppose lastly, another type of financing would fall around, capital or revenue grants. Now, capital grants usually for fixed asset additions, and now whilst they are not immediately taxable as such, what will usually happen is if you buy a piece of plant and machinery for say £100,000 and you have a capital grant of £20,000, you should only be able to claim capital allowances on the net amount being the £80,000. Revenue grants are ordinarily taxable. So again, if you're getting a revenue grant through, just taking into consideration that it will be taxed as income. And another area then is around, I suppose, falling within a grant, but thinking of it from a group perspective or a company perspective, is that whether or not contributions are made. So one thing that we are actually seeing more of is, instead of companies making intercompany loans, cash generative businesses actually looking at making contributions or effectively gifts to other entities within the group or related parties. And what we'll talk about it later on is one of the benefits around that is, one, it strengthens the balance sheet because it doesn't create an intercompany loan, but also it helps in terms of any further or any future debt restructuring, because sometimes, and what we'll talk about later, is when we have connected party debts and need to restructure that debt, it can be quite difficult to do. So what we just wanted to through was like maybe a plain vanilla structure, typical structure, what we see with many businesses is we have a group of shareholders who will subscribe for some equity. That will go in and strengthen the balance sheet. There may have been a period of trading and put some profits there, which allows a bank or a third-party lender to provide some debt within there. So from a typical structure here, what we can see is like the debt coming into the trade company, interest payable on that debt should be deductible. The equity, so what was being subscribed for in the shares, that equity, there will be no deduction on the subscription, and then any dividends paid by the company in respect of that equity will not be deductible either. What we'll go on to later on in the presentation is a scenario whereby you're looking at a fund investing and the various implications that we have to discuss around or consider around that position as well. So Natasha, we want to maybe flick on, and without getting into too much of the tax legislation and the detail around that, what we're going to consider is what is debt for tax purposes. And what we'd say is that the taxation of corporate debt in the UK is complex. When people think that interest or debt is deductible, unfortunately it's not, and there's a lot more consideration in respect of that. We also need to consider whether the loan relationship rules, which are the main governing legislation in the UK, apply to it. I suppose, why is it really important? Well, it's important to determine whether that there is a debt has been created, and a debt is created for when there's a transaction of the lending of money. And the transaction of the lending of money can occur from a number of different things. So what we have are, simple things that we all know: cash, if there's been a cash loan, if there's trade debtors or trade creditors, interest payments. But other areas which you may think create intercompany loans but don't are things like if we have a transfer of trade and assets. So if you have a group and you are transferring the trade or say a property from one group company to another, whilst that creates an intercompany balance, it doesn't necessarily fall within what we deem the loan relationship legislation. And I suppose, why is that important? Well, it's important because when you're maybe looking for additional finance, and if you've been trading for a period, you may have various intercompany balances, you may have shareholder loans, etc. And in order to avail of further finance, you may need to restructure your current debt. And the loan relationship rules govern really how the restructuring of debt is taxed. Ordinarily, if you were to release a debt, or a debt is released on your behalf, any credit to the profit and loss account may be taxable. So in order to avail, and what we try to do is ensure that in order to avail of that additional finance, we don't want to crystallize a taxation event. So there's a number of areas of legislation that we try to work around. What a lot of people do now, a lot of shareholders do with their debt, is if there's a lot of shareholder debt in the company and you're reaching out to a third party financer for additional debt, they may ask that, may request that an element of that shareholder loan is forgiven. So in order to do that, some consideration should be given to doing what's called a debt for equity, whereby an element of the debt is released for the issue of ordinary shares. And what that does is, one, it helps strengthen the balance sheet. It may provide that shareholder with additional shares, and it should provide the shareholder with additional shares. Also, it may increase the shareholding, but what it should do then is facilitate further financing coming through. Other elements around it might be if you're going through a refinance, whereby if you've got, for instance, £100,000 of debt in your balance sheet, it's been agreed that you've got someone coming in who's going to provide, say, £80,000 of debt, and it's going to be facilitate that refinance. Now, and if you've got both parties that are agreeable to that, what would happen in the company is that you would have a £20,000 credit, which would be subject to tax ordinarily. However, there are some other additional principles that, such as the corporate rescue exemption, and if that was to apply, what that allows us to do is actually release that 20,000, and it wouldn't become taxable. So for the corporate rescue exemption to apply, there's a number of conditions to be met, but the broad principle is that if the business can't continue to trade within the next 12 months and the debt is fully released, that credit shouldn't be taxable. Other ways of looking at it would be again looking at doing a debt for equity, albeit usually that isn't really practical from a commercial perspective if you've got an unconnected third-party financer there. But if it's a connected company, again, there's principles within there that allow us to release the debt and not create, if it's done under a formal deed of waiver, such that the credit isn't taxable. Now, again, there's a number of exceptions to the rule of whether that interest is deductible, and I know Lorraine's going to cover a number of those off fairly shortly. In terms of equity, then, what we have is the general principle is that any payments in respect of equity are not deductible. So most people will be fully aware dividends paid by a UK company will not have a deduction on those. And similarly with the preference share coupons. Now, one of the benefits of looking at equity, especially for those early growth stage businesses, those which are maybe a bit higher risk and what's very much legislated for, is around EIS and SEIS. So the HMRC fully understand that these, I suppose, early growth stage businesses with higher risk will find it difficult to attract investment. In order to do that, they have legislated for what's called EIS and SEIS. So broadly, what EIS and SEIS are that for investors, for the issue of new shares, they will be able to receive 50% for SEIS and 30% for EIS income tax deduction. If they're able to hold those shares for more than 3 years and there's an exit event, any profits won't be subject to capital gains tax. For EIS, and there's also a CGT deferral, and if those shares were to make a loss in the future, that they can be set against that investor's other taxable income. So what it does, it makes it very attractive for investors to look to invest into equity. Now, again, what some of the benefits for the company itself, you can go and get pre-approval from HMRC, which also means that it gives a bit of comfort to any investor that what they're investing in, they'll be able to avail of these reliefs. There's a lot of compliance around this area. Again, it's probably one where you could do a session itself on. But what we do find is that those sort of businesses that are able to attract these investors, and you'll find them as well, a lot of business angel investors will go through them, are the advantages for those investors is that, you know, even if they were just to get their money back, they're already up. So it's, you know, there's a break even point at probably every sort of 50p in a pound back, sort of because of the various tax reliefs. What I'm going to do now is I'm going to pass across to Lorraine. I sort of covered very much an overview of what, you know, tax implication, or what is the basics from a tax perspective. But going through the deductibility for tax purposes now, there are a number of areas that businesses should be aware of, where it's not just as if you're paying 100,000 of interest, it's fully deductible. So I'll pass on over to Lorraine now.
Thanks, Mark. Maybe just go back a slide. I think it's maybe pushed on a wee bit. So morning, everyone. Suppose Mark's probably went through a lot of the ways you can get funding for your company. One of the main things that we see in practice now is obviously whenever you're applying for funding and you're looking at cash flow forecasts and business plans, one of the big issues within that is tax, and tax is now quite a significant cost to the business. Obviously with corporation tax currently at 19%, but that's going to increase now in 2023 to 25%. So it really is sort of critical that your business, if you are paying interest, that you're getting as much of that deduction against that as possible. So the first thing I want to look at is around the unallowable purpose. So this is probably just a very general rule that's always been in the UK tax legislation, and it's really just making sure that the interest is for the purposes of the trade. So it's really, you will get a restriction, or you won't be able to allow any of that interest if it's for any activities that are outside the scope of corporation tax. So if it's for an exempt activity, if it's got, if it's for financing that is totally unrelated to your trade or your business. And there's also quite a lot of anti-avoidance around this. So really, if you're receiving interest that's going on a sort of circular motion, or if it's multiplying losses from other businesses within the group. So really just need to be careful for that very general rule. It also pulls into includes that in foreign exchange costs as well, can fall within the allowable purposes, and that really will sort of fall around if there's needs to have a genuine exposure to foreign exchange. It can't be sort of just falsely created, and just making sure that there's no non-commercial features within the structure. Another one that sometimes people fall across on is sort of borrowing from an exempt body. So for example, if you've received funding from, say, a pension fund, any interest payable to that pension fund is not allowed to be included in your corporation tax deduction. Secondly, then you have the transfer pricing rules. So within the transfer pricing rules, there's just really the broad basic principle is really that if you're interacting with related or connected companies, you need to be contracting on a basis as if they were third parties. So that's sort of just the general rule. Within that, then we sort of come on to the thin capitalisation rules. And that's really where you're receiving loans or providing loans to related parties or connected companies within your group. And what HMRC will look for is if you're treated as acting together, so that you're really acting together to create the finance. What the two main things that will be looked at in relation to this is the sort of quantum of loan and then the terms and conditions of the loan. And really what needs to happen is it needs to be looked at as if it was a third party lender providing you with that loan. So it's probably looking at, you know, would you have got that quantum of a loan from a bank or a sort of building society or sort of mainstream lending funder. There's a lot of grey area in this legislation because there's lots of mezzanine finance, private equity buy-ins and things like that. So it's really looking to see what type of finance, what the terms conditions are, like what the rate of interest is, what the repayment terms are, you know, if there's any certain conditions that need to be met on that. And really what that seeks to allow is that some of that interest may not be treated as deductible. So it could be that you have interest in your P&L, but you're not being able to claim the full amount of that against your corporation tax return. So the main thing is, what would a lender provide you with? Not what could a lender provide you with. So that's the difference in the test there. One things that we would normally look at and consider is sort of interest ratios. And so I suppose looking at your EBITDA, the ratios for it, sort of a debt to equity ratios, debt to EBITDA ratios, debt to assets as well. So all those things need to be considered when you're looking at that. Some other things that then need to be considered is sort of the credit rating of the company, which would then obviously, you know, if it's of a lower credit rating, then obviously a higher interest amount should be allowable. What sort of internal support are you receiving? So sort of, is there another group in the company or a company in the group that is providing you with guarantees on that? We see this quite a lot whenever private equity investors come in, and we'll look at a case study later on and looking at sort of how there is then capitalisation restrictions in sort of cash flows and financing that then is received by the company. What you can do is you can actually apply to HMRC and put an advance agreement in place. So whenever you're looking at the financing, you can outline the financing and the backup for all how those percentages and the terms and conditions and the quantum of the loans, and outline that all to HMRC and agree an amount of what percentage of that interest is allowable each year. And then that means that protects you then going forward whenever you're doing your corporation tax return for the life of that loan, that is allowable. And you're not going to have the fear of sort of being inquired into and any sort of retrospective adjustments being made. Then that nextly then also runs across into sort of anti-hybrid mismatch rules. So one thing I should mention is within capitalisation and anti-hybrid mismatch rules, there's no threshold, so that can apply to very small businesses, very small loans, right through to very large loans where you think there could be restrictions in place. So the anti-hybrid mismatch rules are quite similar. They're again in relation to related party loans or connected party loans or group loans. So really, if there's a loan that's in place and you have a connection with that party that's providing you with the funding, these may fall into place. So really they're quite anti-avoidance rules. So really it's mostly in relation to interest received from overseas. So really if you're receiving income or if you're paying interest into another jurisdiction and that other jurisdiction isn't taxing that income, majority of the times you're not able to claim that as a deduction. The other point that may fall into within the hybrid mismatch rules is where you're paying interest and the company is a hybrid entity. Usually it's mostly US companies where there's look-through entities there, where that interest was then treated as a deduction in the foreign jurisdiction. So there would be a double deduction. Then you're not able to claim that in the UK against your UK tax return. Another one we see quite commonly, and a lot of this is sort of because of the quantum of funding that's coming in local businesses, suppose from either overseas or private equity and mezzanine finance, is a corporate interest restriction. Now, this is not something that applies to everyone across the board. It really is very much on the quantity of the loan. So really the threshold here is if you have 2 million of interest, and that's net interest. So you're able to net off interest income and take that off your interest expense. And if that interest expense is less than £2 million per year, you don't have to worry about the corporate interest restriction. It's whenever you break that threshold, and that threshold is a group threshold. So it's your whole group needs to be taken into consideration in relation to that. The general rule of thumb and the ratio that most people use is really a 30% of EBITDA. So you can either take the 2 million, and anything above that is then taken, you're not allowed to take it as a deduction, or you can then calculate what 30% of your EBITDA is and then take that as a deduction. There is additional ratios, and it does get into a lot of complex calculations, but there you can increase the deduction if you have a worldwide and have international companies in the group. But it's something you need to report to HMRC each year, and it's a real area of focus for HMRC that we've noticed with some of our clients. And finally, just in relation to a close company. So a close company for tax purposes is a company that there's 5 or less participators. So really there's less than 5 shareholders. You may fall within the close company rules. And that will sort of look around if you're accruing interest and then not paying it within 12 months. There may be some restrictions. And then also we've seen close companies where maybe the company has lent money to the shareholders to maybe invest in something else that's outside the group, and you may fall within the section 455 rules where you have to, if that loan's not repaid within 9 months from the year end, then you could have a tax charge on that. So that's probably quite a lot of information I've just provided you with there, but those are the main things that we see coming up in relation to deductions for interest. And just on to the next one. Obviously, Mark has outlined all the different various types of funding that you can get, and I suppose interest is one of the big major players in that. But if there is intercompany, if you're getting finance, and especially intercompany, you probably just need to look to see whether is it capital or revenue. I know Mark has went into a bit of detail around the debt and the equity piece. So it's obviously, so it's just to reiterate what Mark has already said, if it is a capital payment, there's no deduction then for UK tax purposes and that side of things. If it's revenue, if it's a revenue cost, then you should be able to get a deduction, obviously subject to the other rules. Suppose interest is one of the main amounts that it will be repaid back along with the sort of equity part of the loan. Another way to sort of clear intercompany loans is by way of dividend. Now, obviously, you don't get any corporation tax deduction for the payment of the dividend, and you also have to make sure there's sufficient reserves in relation to that as well. Another point that's sort of now becoming more common is if you've got sort of maybe an Irish company or a company in the EU, especially since Brexit, you may need to withhold tax on the dividends. So there's sometimes maybe a bit of paperwork that now needs to be put in place in relation to that. Interest, which is probably something I've already went through in relation to the deductibility. And I just wanted to sort of highlight it on the next page around the withholding tax and interest as well. Another sort of maybe side of things in relation to intercompany loans is, sometimes you can repay those via management charges and royalties, and that's something that's very underutilized, and we find within groups as well. So it's worthwhile considering if there's an intercompany loan, how can you reduce that, and maybe using that to offset that. And obviously, if there's a management charge, you'll be able to get a deduction or a royalty as well within your corporation tax return. So worthwhile having a think around those as well. Finally, just want to touch on the withholding tax interest on interest. And this is something that we see a lot of companies just seem to forget about, that there's a nice big funding structure being put in place, with lots of different ways that's come through, but maybe it's sometimes just a small bit of paperwork that seems to be maybe forgotten about. So it's worthwhile to keep on the to-do list as well. So really, if you're paying interest which is outside of the UK, you need to withhold interest on that. So it's withhold at a 20% rate. So it's usually if a payment's to an overseas company, or if it's to an individual. So maybe an individual shareholder has provided with a loan. Once that interest is paid, you need to deduct 20% of that and complete a CT61 form. And that needs to be completed within the quarter of that payment being made. So it's also then looking around, you can put procedure in place with HMRC to apply that the loan doesn't need to be have withholding tax on it, and that documentation needs to be put in place prior to the interest being paid. So really the UK withholding tax arises if the interest has a source in the UK, if it's yearly interest, and that when it's actually paid. So if the interest is just accruing, there's no requirement to withhold the tax on that. So really, there's, you just need to look at the source of the interest as sort of the place when the debt will be enforced. So that's looking at the agreement. Usually, if there needs to be, where the loan agreement is, if there needs to be a dispute over that, which court would that be in? That usually is one of the key factors. The source from where the interest is paid. So if it's an NI company, it's likely going to be an NI. And where the interest is paid, okay, majority of that it's nearly an irrelevant point now because everything's paid remotely. And then sort of just where the location and the security of the debt. So most of these funding structures will have some sort of security for it, and that's likely going to be a local business, either your trade or your stock or some assets that are held within the company. So it's worthwhile having a think to see, have you paid interest and does there need to be withholding tax on it? It's just this very small point that HMRC can come after, and then you may be liable for it instead of the person that you're paying the interest to. And then Mark, we just wanted to maybe run through a final structure chart there.
Yeah, no, look, thanks, Lorraine. I suppose that this sort of structure tries to bring nearly everything together and bring everything to life. A caveat with this is, I'm going to say a typical investment structure. Charlie mentioned at the start, obviously PE funds have a lot of money at the minute and are looking at investments. So what I think we can do is just sort of talk through what this looks like, and then sort of go through maybe just in a sort of from a high level perspective, the tax implications. But what I want to do initially now is just talk through the commercials around some of these transactions. So ordinarily, what we would have would be a trade company with the shareholders, which would hold equity. There may already be initially bank debt within that. In order to help grow the business, and sometimes obviously for shareholders, it allows them to maybe get a bit of cash off the table. A private equity fund may come in to acquire an element of the shares. In order to do this, it's usually done via a mixture of debt and equity. Now, a lot of the shareholders, I suppose, if you're the shareholder of the trading company, you don't really see what happens above the trade co. But for a fund, typically what you would find is that they will have a sort of 2, 3, and I've been involved in transactions where there's maybe 5 or 6 companies in the funding structure to acquire the trading company. And the rationale behind a number of these things, part of it is tax driven, and the other is commercially. It provides a bit of flexibility in terms of future financing. Again, looking at this, if it was a UK fund, the tax implications may not be as bad unless you're, Doreen had mentioned there previously, if you have a US fund, etc. involved. But in terms of the steps, ordinarily what would happen is that the fund will put money into Topco, and it will put its share capital in the Topco and its debt in the Finco. Finco will then subsequently push the debt down into Bidco, which will acquire the shares, as an equity payment, acquire the shares from the shareholders. Ordinarily, what we find is that the shareholders, the individuals, won't all exit the company. They'll also end up with shares indirectly in Topco. Now, in order to do that, there's a number of tax complexities, and again, it falls around what type of instruments they're issued, i.e., is it debt or such as qualifying corporate bonds or non-qualifying corporate bonds. That very much has a capital gains tax implications for the shareholders, and there's usually a lot of work that has to go around to ensure that the shareholders can sort of roll up their equity into the new topco structure without crystallizing any capital gains tax on that element. In terms of the funding down, what we have is, the debt in the FinCo. If we assume that those companies are all UK tax resident companies, it will really be dependent on if the fund is UK or not. If the fund is a UK fund, and what we have to consider is what Lorraine mentioned, things like corporate interest restriction, Lorraine. If the net interest is more than the 2 million, obviously those loans, UK to UK, again, have to consider, I suppose, transfer pricing, albeit not probably to the extent if it was a UK to, say, non-UK jurisdiction, to determine the interest deductibility. The legislation's also slightly changed since April 17 around the flexibility on losses. So what used to happen with a number of these transactions sort of pre-17 is that the likelihood is that FinCo or BidCo would have trap losses, being that they have more losses than profits that they can group relieve within the group. And now going forward, there's been from April 17, there's a bit more flexibility. So thinking of cash flows, whereby we would have been restricting the availability of those losses, there is a bit more flexibility now on the use of them in future periods, albeit taking into consideration things like the corporate interest restriction and thin cap. What we usually do see is that the companies are probably thinly capitalized, and there's a lot of debt being put in. Therefore, not ordinarily what we would expect to see as a restriction on the interest, whether that is either under the corporate interest restriction and also thin cap. And Lorraine, you correct me if I'm wrong, but you still have to apply both. Isn't that right?
Yeah, so it really sort of does depend. So obviously when the debt comes in, you need to consider, that sort of circle that it's done, and they're all sort of interconnected. So firstly, you apply the transfer pricing principles, then the thin capitalization principles, and then any anti-hybrid adjustments. And then if you've taken all that out and you're still left with the minimum, that 2 million, you could then follow then the corporate interest restriction rules as well. So there's quite a lot, especially when the funds come in. We usually see there's quite large amounts coming in, and that's whenever the finance code needs to have a look to see, whether all of that interest can be deductible, and then obviously group relieved within the group to get the full deduction there.
Yes, so I suppose nearly the deposition of a group is extremely important to get right. It's one of those things where it's one of those areas where, especially when you're thinking of cash flows, etc., it's really important to consider, one, is the interest deductible, taking into account all those, I suppose, additional provisions Lorraine had mentioned around possible restrictions, but also then when is the debt payable, when is it repayable, is it rolled up and payable and exit? Because again, they will all have cash flow implications. So what I would always just recommend is that if you are going through a restructuring of finance or looking at taking in, especially non-traditional finance, it's definitely worth speaking to your professional advisor just to get an understanding and to ensure that any of those projections that you're looking at, etc., all work through. So appreciate there's been a lot of tax technical thrown in there for first thing on a Thursday morning. So probably, but unfortunately that's what we deal with on a day-to-day basis. So I'll maybe pass over back to Charlie now for some Q&A.
Thanks, Mark and Lorraine. That was very, very comprehensive, and certainly I know why I walked down to your desk to get some of those questions answered effectively. So I suppose from the audience point of view, clearly the level of sophistication of your funding has obviously probably greater impacts in relation to some of the issues that Mark and Lorraine have talked about. But certainly within the last 10 to 15 years, we've seen that environment around the types of funding change. So we need to be absolutely up to speed in relation to what is, because there is that tax or that cash flow impact. And I suppose the other bit is that there was chat obviously in relation to groups and I suppose bits of international as well. And you know, the answer, well, why is those relevant? But 45 miles down the road, we have ROI, and the number of times that from a funding environment where SMEs have entities there trying to fund them, etc., and those can be those need to attention to make sure they're done correctly. So we've actually quite a few questions for you guys. So I'm going to, in the interest of time, I'm going to try and probably weave some of these points together, if you don't mind. So the first one is, I suppose, a question around at what stage of a fundraising should the business to be looking at tax advice. And I suppose the secondary point is someone's asked about in relation to the processes with revenue and clearances, etc., around structure. So again, given that if you're trying to maybe fundraise in March, April of next year, you know, again, how much do you need to be building in for that interaction with revenue? So again, Mark, Lorraine, who wants to maybe pick up those two questions from delegates?
Yeah, I think, Charlie, I suppose one part of it is, I won't say it depends. It depends on the type of fundraise. I think if you're looking at issuing shares and you're going to go down, you want to go down the EIS/SEIS route. You want to get your advisor in as soon as possible, really, because you want to go and get that advance clearance from the revenue, which can take more than 30 days to get. So it's worth having that, because I think that bit of paper will attract investors. You know, obviously you have the business plan, etc., there to substantiate it, but the de-risking element of having those reliefs is really important, and we definitely see that with any of our sort of high net worth individuals who are investing in these type of businesses as well. In terms of, again, I agree, like if you're looking at private equity or even substantial bank and mezzanine funding, it's worth having someone run their eyes over that and run their eyes over projections from a tax perspective, just to ensure that what they're looking at works. And in terms of those other cash flow pieces, again, thinking of things outside of the box like capital allowances and research and development, both really attractive tax reliefs that can reduce liabilities down, and in respect of the likes of R&D, you know, could ultimately end up with a repayment. So can actually, you know, have a positive impact of their cash flow, and can have an impact, and actually then, you know, can allow them to decide, do they actually need to go out and attract as much finance or you know, as they originally intended.
Okay, and Lorraine, I think one for you. Someone's asking in relation to transfer pricing. Is there a reference database or website that's used to benchmark transfer pricing, or is that via a tax advisor?
Yeah, look, probably 9 times out of 10, Charlie, it's via a tax advisor. There is a lot of databases out there, but you know, you need to have a license to use them. So ordinarily, most companies would enlist the help of an advisor to do that, because it's just not cost efficient to have the license for maybe only one loan. But yeah, look, I think a lot of it is making sure you have as much data as you can to provide with your tax advisor, and sort of keeping records of any discussions you've had in the past with either your traditional lender before you went to mezzanine finance, or a non-typical funding provider.
Okay. And I suppose another question here, which I suppose ties into what our expectation is. We believe there is going to be a fair wee bit of restructuring of existing, particularly in relation to debt, etc., in the next sort of 12 to 18 months. Now, somebody has taken that further in relation to, I think it's for you, Mark, in relation to your reference to corporate rescue, in relation to, is there a requirement for application or declaration with HMRC? So quite a specific point.
Yeah, the corporate rescue exception, the legislation is very grey, and the guidance with the revenue, surprisingly, is very grey. But what we would typically look to see, and sometimes this is where an insolvency practitioner can get involved as well, albeit it's not that the company is going to be put through an insolvent procedure. It's to look at the balance sheet. Is it a negative balance sheet? Could it trade for the next 12 months? And if so, if it's not able to do that, if the debt was called in, would it, effectively have major implications in the business? There's a number of criteria to go down and check out, and it's looking at those it's looking at the sort of the next 12 months. I've actually went for a non-statutory clearance to the revenue in respect of one of these. It did take about 7 or 8 weeks to come back to get it approved, and it was because it was I suppose it was coming from a non-related party. We have seen in the past where you may have a company that is not necessarily connected, but there is a relationship there, and when they go to release that debt, the revenue have actually said no, that it wouldn't fall within the corporate rescue exemption, on the basis that, because they haven't sort of sought to reclaim their debt in the last number of years, or their interest payments, that it's actually more of a tidy up exercise. And what that unfortunately does for the business is that the credit to the P&L, of the profit and loss account, for that business which really needs to restructure the debt, actually becomes taxable. Now there are other ways of getting around it, which would have been used pre-corporate rescue exemption, and I suppose pre the last credit crunch back in, I suppose it came in 2015 or roughly about 2014. But there are other ways of getting around it. But again, it doesn't necessarily mean that they work from a commercial perspective.
Okay, that's fine. Just hopefully too quick fire. I'm just conscious of time. The what you guys get the crystal ball out. So capital gains tax changes. What answer are you going to give us in relation to whether rates are going to potentially go up and when?
Well, I got it right when they were bringing the 10 million entrepreneurs relief allowance down. Didn't get it right when I thought I might have changed again in the last budget. I think there was a lot of discussion in the pre the last budget around capital gains tax changing. It's been very quiet around it. I think the amount of money the government's going to make off the change in the NIC rate, it probably completely dwarfs what the CGT rate is, albeit, my head's my bets here. I think back when I started in tax, there was a capital gains tax rate of 40% for investment assets. Now, whether that could come in the not too distant future, that is something that might be there. Yeah, not a betting man, so don't know.
Yeah, no, certainly a topic of conversation with a number of people. Again, I suppose the practicalities again around tax in relation to that. If that tax changes, obviously, to get the same money potentially now or 3 or 4 years down the line, that tax is a big impact on that.
Yeah, sorry, just a quick one on that. We have seen clients, prefer to nearly, especially if they're going through a transaction, pay all their tax, nearly create a dry tax charge and pay their tax now, having certainty of a 10 or 20% tax rate. And then so they don't have to nearly worry, they'll only have a smaller element at a potential higher rate down the line.
Okay, and just one final one then, again, referencing, I suppose, the cash flows. I think you mentioned capital allowances and obviously the super deduction, Mark, so people who are looking to invest, and obviously that reduce the reduction in tax. The issue then, I suppose, is in relation to with also corporation tax rising in the future. So what is that, a Peter to pay Paul scenario, or what are you seeing with clients?
Yes, yeah, I think there is a bit of that, because I think when you look at it, corporation tax rate is going up to 25% from April 23. The super deduction, as it were, stops before then. So what you've got actually, what you actually have is when you work it out, I think it's roughly the same. It's not right, Lorraine, or slightly less if you do it now compared to, in the future. So I think if you look at your projections, and your projections are very healthy. I know cash is king, and people maybe want to save the money up front now. But if you're able to sort of push it out, and you don't need to bring forward a lot of capital investment, it might be worth just holding off and investing at the time, in after 23, because you will get that 25% CT relief, albeit I'm not sure what way the annual investment allowance will work at that stage.
Yeah, and then somebody has just come in with on final one, is, can interest rate relief be backdated?
Yeah, it can get quite complicated, Charlie, if you want to start backdating it. But yeah, I've dealt with disclosures with HMRC where interest hasn't been calculated correctly for prior years, so you can make a voluntary disclosure or an overpayment relief claim. But as long as you have a sufficient backup, yeah, it is possible. It's just not extremely easy.
Okay. That's been really good. I'm sure we could go on for hours on this. I expect in relation to all that, and I say it's every day is a learning day for me in relation to tax. But thank you very much to Mark and Lorraine this morning, and certainly Shane mentioned the one-to-one session. So Gary's going to be sending out a communication from InterTrade tomorrow, and there will be an opportunity for people to avail of some of the slots there. Hopefully our next funding advisory event may well be in person. We're hoping that will happen. So it'll be really good to, as well as digesting some of the content, obviously, to try and get that important networking elements and meeting up with funders, etc., etc. So we keep fingers and everything crossed that will happen. So we're also keen to get feedback from people. So if people think there is things that we should could be covering, please also let us know through Gary's email as well. So, but again, conscious of time, and thank you very much for people's participation. So lots of people, lots of interest in this topic. So, and again, I say it's been videoed, so people can watch it back if they want to on the InterTrade website. So, but I wish everybody a happy and profitable rest of day. So thank you very much. All the best. Bye.